The following information was extracted from the records of Jingle Limited on the year ended 31 December 2010. Extract from the statement of profit or loss starts at gross profit, other income, interest on fixed deposit, profit on sale of equipment, dividends from listed shares, bank charges, interest on mortgage bond, loss on the scrapping of a vehicle, depreciation, other expenses, and profit before tax. Statement of financial position. There we have property, plant and equipment, listed shares at cost. Do you see the movement taking place there? It's our silent partner. Make sure that you have actually made a note of that. Fixed deposit. There's another silent partner, I can promise you. Inventory, debtors, bank and cash, and then ordinary share capital, retained earnings, mortgage bond, creditors, taxation payable, and bank overdraft. Then they give us additional information what property, plant and equipment is all about. And then they're going to tell us an old vehicle, things about the vehicles, things about equipment. The listed investment consists of 8850 ordinary shares of R2 each. The market value of these shares is 23,000 Rand. Now guys, if we did fair value accounting or valuation accounting based on the investment value, then we would have taken this 23,000 Rand into consideration. However, we do not do that in this year. We only base all investments on cost. So we show the cost. So therefore, we are not really interested in the market value. The only place where you should be interested in the market value is when we're going to disclose the investment note. You are supposed to mention what the market value of those shares are. The gross profit percentage equals 25%. Now, if we go back to the income statement that they gave us, they only gave us gross profit, which was 60,000 Rand. So that means if I can work back, I can calculate now my total sales. So my total sales for the year equals 240,000 Rand. Why do I need that? Well, if I'm going to show the cash flow statement and I'm going to apply the direct method, I have to show cash received from customers, and for that I need the sales figure. A dividend of 5760 was declared and paid, and then taxation for the year amounts to 28% of profit before tax. None of this information will have an impact on the profit before tax, so therefore I could have taken that profit that we have there, 45,500. Let's do that. Times 28% will give me my tax charge in the income statement for the year, which equals 12,740. Good. So let's start. They want us to do the statement of cash flow with notes for the year ended 31 December 2010 in accordance with IFRS. Use the direct method. So the first thing that we want is cash received from customers. Now there's nothing fancy that happened in the debtors accounts. We have already worked out our sales amount, 240,000, and that we're going to adjust for the movement in debtors. Hopefully that 35,000 has paid us now, but from the current year's sales, 25,000 Rand is still outstanding. So let's have a look. Where is our, here it is, sales, 240,000. There was a decrease in debtors from last year to this year of 10,000. So that means that it's a cash inflow. I have received the money, 10,000. So total cash received from customers being 250,000. Cash paid to suppliers and employees. Now, before we're going to get there, let's do all our PPE adjustments. The first one is vehicles. So let's do land and buildings. Let's do land and buildings first. We had an opening balance there of 96,000 Rand. We had a closing balance there of 106,000 14,000 Rand. That is all about vehicles, that's all about equipment. So, ordinary share capital, there's no revaluation reserve. So therefore, opening balance 96,000, closing balance 106,000. So new land and buildings acquired 10,000 Rand. I think it's safe to say that that would be in our cash flow from investing activities, increase purchase of land on buildings for expansion purposes, 10,000 Rand cash outflow. Great, let's do the next one. Vehicles. Opening vehicles at cost, vehicles at accumulated depreciation. So opening balance at cost 45,000, closing balance 50,000. Opening balance 45,000, closing balance 50,000. Then what our accumulated depreciation is concerned, opening balance 25,000, closing balance 14,500. Opening balance 25,000, closing balance accumulated depreciation 14,500. Let's see what they say about vehicles. An old vehicle on which the useful life has expired had been scrapped on 1 January 2010. The cost price was 15,000 Rand and accumulated depreciation was 14,500. So let's take that out of the accounts. Cost price was 15,000. We're going to transfer that to our asset scrapping, 15,000. And the accumulated depreciation was 14,500. And we're going to transfer that to the asset scrapping of 14,500. Great. Then, in our income statement, we had a loss on the scrapping of the vehicle of 500 Rand. So in our scrapping account, on the credit side, loss on the scrapping, 500 Rand. And then this account is actually in balance. So there was no proceeds. We just wrote off our vehicle, which we have scrapped. So loss, 500 Rand. There's nothing more on vehicles. No, I'm lying. A new vehicle was acquired on credit on 1 July 2010 from WV Motors at a cost of 20,000 Rand. The monthly payment of this vehicle was 500 Rand per month, and the remaining balance owing to VW Motors on 31 December 2010 is included under creditors. Now, obviously, we received finance, and finance is excluded from creditors. So we have to take that out because we're going to show that 20,000 Rand that we have received from whoever is providing the finance. Let's say it's a bank. We have received that money from the bank, and then simultaneously we have repaid some of the money to the bank. Depreciation on vehicles is calculated at 10% per annum on the straight line method. Let's just quickly work out how much money have we repaid. We have bought that vehicle on the 1st of July. So from 1 July to 31 December, we have repaid 3,000 Rand on the vehicle. So the first thing is that our asset has increased with 20,000 Rand. So we have purchased an asset of 20,000 Rand. Here, under cash flow from investing activities, replacement of vehicles, 20,000 Rand. Now we received 20,000 Rand worth of finance on that vehicle. They told us here that we were given, we bought that on credit actually, and we are repaying 500 Rand per month. So the bank came in, they paid WV Motors the money, which indirectly, instead of paying us and we paying them, they paid them directly, and then we repaid the bank 500 Rand per month. So part of our financing activities, we would have had the payment of the vehicle of 3,000 Rand as a cash outflow, the 500 times 6, and as a cash inflow, the finance loan from the bank, 20,000 Rand, and that was to cover that replacement of the vehicles of 20,000 Rand. Great. if we go now to the vehicle account, you will see that this account is actually in balance. So there's no additional vehicles that was purchased. This was the only one, this account balance. If you go to the accumulated depreciation account and we balance that one off, then we see that our depreciation charge for the year, that's our balancing figure. That's the only thing, or the only thing that can be on the credit side of the accumulated depreciation account, being our depreciation expense for the year on the vehicles of 4,000 Rand. The scrapping account is also coming to zero. You can actually prove the 4,000 Rand. You can say, well, you know what the cost price was. It's a 45 less the 15 that you've sold, which gives you 30,000 times 10%. It's on the straight line method. That gives you 3,000. And on the new vehicle, 20,000, you've acquired it on the 1st of July. So you use it for 6 months times 10,000 equals 1,000. So there is the total depreciation of 4,000 Rand. Good. Now the equipment account. Equipment account have in the cost account an opening balance of 30,000, a closing balance of 25,000. 30,000 closing balance, 25,000. Then it also has in the accumulated depreciation account an opening balance of 9,000 and a closing balance of 9,700. Opening balance 9,000, closing balance 9,700. No equipment was acquired during the year. But look there, the cost price has reduced with 5,000 Rand. So if nothing was acquired, then it means that that movement in the cost price must equal the cost price of goods sold. And that equals 5,000 Rand. Old equipment with an accumulated depreciation balance of 2,000 Rand was sold on 31 December, on 31 December was sold at a profit on 30 June 2010. Now, depreciation in equipment is calculated at 15% per annum on the diminishing balance method. So what was the carry value of this asset? Remember that 2,000 was as at the end of last year. So the carry value of this asset at the beginning of the year was equal to 3,000 Rand. What was the depreciation on this asset? It was a 3,000 Rand diminishing balance multiplied by 15%, multiplied by the number of months that we've used it, which equals 6 months of the year, and that gives us total depreciation of 225 Rand. So now we can take this thing out of our books. What are we going to post first? The depreciation. So now accumulated depreciation for the year 225. Now we're going to remove that out of the books. So what are we going to remove? Cost price of 5,000 and accumulated depreciation, which is now 2,000 plus the 225. So we're going to take out 225 to the 2225 to the asset disposal account. 5,000 cost, accumulated depreciation 2225. Now they give me in the question here the profit on sale of equipment. Profit on sale of equipment was 225 Rand. So asset disposal account, profit on disposal 225. So that means that the balancing figure on the credit side of this asset disposal account equals the proceeds on the sale of the asset, which was 3,000 Rand. Now, they've told us in the beginning that there was no new equipment acquired. So therefore, this account is now in balance. Our accumulated depreciation accounts still need on the credit side a balancing entry. And the only thing that can be is the depreciation on the old assets, which we still have. Now that one, that 2225 is going to be that 2,700 Rand. You can also prove. You can say, well, the depreciation on the old equipment, what was the cost price of the equipment left? 30,000 less 5,000 equals 25,000. What was the accumulated depreciation? 9,000 less this equipment had accumulated depreciation as at the beginning of the year of 2,000 Rand. So therefore, accumulated depreciation on the old assets, 7,000, 9 less 2. That gives us then a carry value of the old assets at the beginning of the year of 18,000, multiplied by 15%, gives us depreciation for the year of 2,700 Rand. So we have proved that amount, and we have proved that amount. Now, what is my total depreciation for the year now? It is that 4,000 Rand, it is that 225 Rand, and it is that 2,700 Rand. So total depreciation for the year, 6,925. Now coming back to our this one, proceeds on the sale of equipment of 3,000 Rand. That is part of our investing activities. Proceeds on sale of equipment, 3,000 Rand. Now, let's go back here and let's go and determine now the cash paid to suppliers and employees. Where do we start that calculation? Guys, we start that calculation with profit before tax. Profit before tax. And if you go back to your information here, the profit before tax, that is 45,500. Now we're going to adjust that profit before tax, number one, for non-cash flow items. What non-cash flow items did we have? We had profit on the sale of equipment, we had loss on the scrapping of the vehicle, and we had depreciation for the year. So if you're going to follow this approach, depreciation 6,925, loss on disposal of 500, and profit on the sale of 225. If you do the T account, profit on the sale will be on the credit side of the account, depreciation will be on the debit side, and loss on disposal on the debit side because they are expenses and the profit is an income. Non-cash flow items. What is the second thing that we're going to do? And that is also our reconciliation. Reconciliation of profit before tax and cash generated. There we're also going to start with profit before tax 45,500, adjustment for non-cash flow items, depreciation, loss on the scrapping of the machinery, and profit on the sale of the equipment. The second one that we're going to have to make an adjustment is separately disclosable items. So that 1,500, what are we going to do? We're going to take it out of its interest received. So we're going to take it out of our profit before tax minus dividends received. We're going to take that out of our profits minus 775. We're going to add our interest on the mortgage bond of 5,200. I think that is going to be all. And that is our the separately disclosable items. There it is. Exactly that same thing we're going to do here with cash paid to employees and employees. Profit on the sale, dividends received, and interest income. The only additional thing that we're going to take out in our amounts paid to our suppliers and employees is our revenue figure. Our revenue figure has got absolutely nothing to do with expenses. Therefore, we're going to take out revenue, and we actually calculated revenue from the gross profit, which was equal to 240,000. So here we took out the 240,000, but in our reconciliation note, we do not do that. And why not? Because we are reconciling this line and that line, not this line, that line, sorry, that line there. And that line is both income less expenses converted into cash. So when we reconcile that line, we cannot take income or revenue out. But when we're actually calculating this line, we have to remove the income because it has been included in that line item above them. Good. Now, our total expenses, 184,375. We did exactly here. Finance cost, separately disclosable. Dividends received, separately disclosable. And interest received, separately disclosable. And there we took out our revenue. So everything that's going to stay behind in this account is going to be expenses. And here we actually also worked out that expenses of 184,375. 375, which is now being accounted for in the income statement. So what we have to do now is to do the adjustments to take out the impact of the accrual basis. Now, if we go to our statement of financial position, you are only going to focus on items that have an impact on expenses now, because we're busy converting expenses into a cash item. Inventory, I buy inventory, so it is an outflow of cash, it's expense. 40,000, 20,000. So I'm going to record that increase in inventory, cash inflow, cash outflow. So outflow of cash, I've got more money entailed in inventory. And then creditors, now you must remember that included in that creditors figure is this amount, the remaining balance owing to FWV Motors as at the end of the year is included in creditors. So what was the initial amount? 20,000. How much have we repaid? 3,000. How much is outstanding at year end? 17,000. So that 17,000 Rand is included in this creditors balance. So we have to take it out first. And then we will have to see what is the movement between the actual balance after we've taken it out. So we're going to compare that then with the 48,500. So 52,000 less the 17,000, that is the actual balance, less than the 48,500, which was last year's balance, and that then gives us a decrease in creditors of 13,500, which is also an outflow of cash. So total cash outflow, cash paid to suppliers and employees, give us a total of 217,875, and we can go and dump it there, 217,875. When we deduct that from cash received from customers, we get our net cash generated by operations. Well, now we can just carry along and we can just complete our reconciliation. We have already dealt with adjust for non-cash flow items. We've already said adjusted for the separately disclosable items. Now we're going to do the changes in working capital, but because we are working on that line, we also have to include what happened in the first line. And the only thing that happened there that working capital is concerned was our movement in our debtors. So in the year we have to take that into account as well. There was a decrease in debtors of 10,000, and then we're going to take into account the increase in inventory and the increase of creditors. Decrease in inventory, increase in debtors. There was also a decrease. A decrease in creditors of 13,500, and that brings us then back to 32,125. So guys, I want to stress, what is the difference between the reconciliation note and this calculation of cash paid to suppliers and employees? The first difference is, this is the difference. With the cash paid to suppliers and employees, I take out the 240,000 out of my profit before tax there. And I do not take into working capital changes into account the movement on debtors, because debtors has got nothing to do with expenses. So that has been taken into account with cash received. When I do the reconciliation note, I do not take out revenue because I have to include revenue because I'm working with a third line which actually includes that line, which includes the revenue line. So I do not take out revenue, and I do take in the movement on debtors as well. So those two are virtually nearly exactly the same, except for revenue and movement in debtors. Good, now our separately disclosable items. Dividends received. Now they gave us dividends received. If you go back to your income statement, you can pick it up again. You've just worked with it, so you can just copy and paste your amounts that you've worked with. Dividends received 775, interest received 1,500. It is received, so it's an inflow of cash. You're going to show us an outflow of cash, interest paid on the mortgage bond of 5,200, and that is those three. Dividends not, I haven't spoken. Dividends received 775, interest received 1,500, and interest paid of 5,200. Dividends paid, they gave me the dividends paid amount in your question. They say a dividend of 5,760 was declared and paid, so you can just use it as is. Dividends paid 5,760, and then tax paid. Well, tax paid, what do you have to do? You're going to take your opening balance according to your statement of financial position. SARS, there was nothing. You had a closing balance of 12,740. Closing balance 12,740. They told you that tax was 28% of your profit before tax. We actually have worked it out. 28% of that amount, which will give you 12,740. So that was your tax charge for the year, 12,740. Do you see your closing balance and your tax charge is exactly equal to each other? So we haven't paid the receiver any amounts in the current financial year. Tax paid, 0. That gives us cash flow from operating activities, 23,440. Now, our silent partners, our financial assets. Let's quickly go and check that, because that we haven't showed under investing activities as yet. Listed investments, that increased with 5,700, and the fixed deposit increased with 10,000 Rand. So here, increase in listed investments, cash outflow, we have bought new investments, so we paid for that, 5,700, and increase in the fixed deposit. As you have to put money, you have to take money out of your normal bank account and you're going to put it on deposit. So it's a cash outflow of 10,000 Rand. We spoke about the 20,000, we spoke about the 3,000, and we spoke about the 10,000. So that all adds up to a net cash outflow from investing activities of 2,700 Rand. Let's quickly have a look what happened in our share capital. Share capital increased with 10,000 Rand. Issue of ordinary shares, 10,000 Rand. What happened to our mortgage bond? Well, there obviously was a repayment, and here's no short-term portion. So the full movement there would be the repayment of finance. Where is it? Decrease in the mortgage bond, 5044 less than 60,000, repayment of 15,740. Here's the payments that we've made on that VW motor, the 500 Rand times 6, and here's the loan that we received of 20,000. So in effect, this 20,000 and that 20,000 cancel each other out. And then the net increase or decrease in cash and cash equivalents, well, that basically is only that 2,000 Rand decrease from 2,500 to 500 Rand. So it is, how does this work? Let me just see. I had 2,500 Rand in the bank. I only have 500 Rand in the bank now. And according to my calculations, there was a negative movement of 2,000 Rand. A negative movement of 2,000 Rand. If everything else fails, just open your eyes. Here's the bank overdraft in this year of 600. So what is our net cash on hand at the end of the year? 5,500 overdrawn. Last year it was 2,500 positive. So what is the movement then? The movement is a net cash movement of 8,000 Rand. So this was correct. Net cash movement of 8,000 Rand. So when I take the 23,744 less 2,700 plus 11,260, it will give you 8,000 Rand.